Hello. Good afternoon. This is Martina McPherson. I'm the president of the Network for Sustainable Financial Markets, the Next Gen initiative, and I'm delighted to welcome you all to the Gender Equality in 2018, the Impact on Investments seminar. This seminar is part of the SDG Webinar Series by BrightTalk in partnership with NSFM Next Gen, which actually provides a perspective on environmental, social, and governance research, insights, and best practices from leading experts in the industry and academia across markets, asset classes, and the entire investment value chain. The 17 UN Sustainable Development Goals are a leading framework for sustainability issues, and they serve as our roadmap to identify, classify, measure, and benchmark key issues. The SDG 5 webinar kickstarts the series and provides insights on diversity, female empowerment, and inclusion strategies and tactics. Our expert speakers are leading researchers, corporate executives, and product experts who will share their top-down and bottom-up perspectives on how diversity risks and opportunities can be identified, evaluated, and benchmarked at a corporate and at a portfolio level. Speakers from MSCI and Thomson Reuters will provide unique insights into how their analysis, as well as their best inclusion practices, have changed the role of females both in the workforce and as investment decision makers. Meanwhile, SSGA will provide a tone from the top and share research and product insights on how actually the Fearless Girl campaign has influenced companies across the globe to increase their gender diversity on their boards. So with these few words of introduction, let me quickly hand over to our expert speakers. The keynote address by Richard Lacaille, the CIO of SSGA, followed by a panel discussion that includes Richard, as well as Robert Walker, the head of EMEA Asset Stewardship at SSGA, Meggin Thwing Eastman, the head of ESG Screening and Impact Research at MSCI, and Patsy Durr, Global Head of Corporate Responsibility and Inclusion at Thomson Reuters, or should I say the former head. She will say a few more words about herself later on. I'm delighted to have these expert speakers here with me, and I'm delighted to obviously now open up to the agenda, which will run us through the next 60 minutes here, obviously with a panel discussion, followed by a public Q&A. Thank you again for everybody listening into the discussion, and with these words, I'm handing over to our first expert speaker, Richard Lacaille.
Hi, everyone, and thanks for that introduction. I'm so happy to be speaking on this topic because it's so important to me. As Martina introduced, I'm CIO, Global Chief Investment Officer of State Street Global Advisors. I also have another role at State Street, which is Chairman of our Executive Corporate Responsibility Committee. So I have involvement and knowledge of what State Street are doing across the whole spectrum of ESG with its own capital, with its own practices, but also as the largest custodian in the world and an asset manager with $2.5 trillion. We've decided as an organization to adopt 5 of the SDGs, quality education, gender equality. We're also adopting climate action, clean power, and decent work and economic growth as things that are particularly relevant for us given our business. But I know today we're going to be talking particularly about gender equality. So that's the kind of top-level State Street view. And we're using our own policies and practices to make sure that we're living up to those sustainable development goals. We know we've got work to do. We're never actually at the state we want to be. And we'll talk a little about some of the steps that we're taking today. So the day job that I had was CIO of State Street Global Advisors. So when we think about, again, ESG, we regard it as a real opportunity for investors to get better returns from portfolios and also to manage risks very, very effectively. And so because we're well known for being in the indexing business, for example, where we own huge numbers of stocks, the way in which we engage with companies and our asset stewardship program is particularly important in delivering on the goals that we have, particularly as it relates to ESG. So asset stewardship will be something that Robert will talk about a little bit later. But I can just reinforce that that's incredibly important to us as what some people call a universal investor. because we want to make sure that we're delivering the best possible returns for our clients. And with index funds, we're not selling securities that might be having challenges. We're trying to improve the performance of those securities through our engagement with stewardship. We go a little further than that, obviously, because we need to look at our own working practices. We strongly believe in gender equality, and we strongly believe that diverse teams lead to better results. We implement that with the companies that we own shares in through our asset stewardship program, but we also seek to do it within our own organization as well. And the investment organization, for example, has got about 600 investment professionals, and we're always seeking ways to get to a better place when it comes to overall diversity so that we can deliver better results to our clients, because the research is quite clear that diverse teams give better results. By mixing points of view, styles of thinking, we can get to a better answer. And we also know that the financial industry itself has not been the most prominent in terms of gender equality or diversity. So we, as an industry, have got a lot to do, but it gives a company like SSGA a big opportunity to demonstrate how it's going to do things a little bit differently to others, and thereby deliver better results for our clients. Because we're very aware that with campaigns like the Fearless Girl, where we've asked companies to have at least one woman on the board and certainly to look at diversity through their organization, we need to look in the mirror and make sure that we're delivering as well. And I think in the investment organization, I'm proud to say we've got some very strong investment leaders. Lynn Blake runs all of our passive equity. That's $1.4 trillion. Laurie Heinel is my deputy global CIO. Raki Kumar runs all of our ESG-related investing. Pia McCusker runs about $350 billion of cash, and Olivia Engel is CIO of all of our quant equity. So we have some very prominent, strong female investors that we've managed to nurture over the years. We've had to obviously take a lot of steps. We've tried from a top-level perspective to ensure that we've got flexibility through our organization wherever that's needed. We've taken other steps like unbiasing many of our, all of our advertisements for jobs, so to make sure that when we advertise for a position, there's no inadvertent bias that might cause, through the language of the advert, people to be more attracted to it from one gender or the other. So neutralizing our adverts has been quite important. And also globalizing a practice that was mandated in a couple of the states in the US. And that's a practice that really helps in terms of potentially eliminating the gender pay gap. In these states in the US, California and Massachusetts in particular, you're not permitted to ask someone what they earn if you're interviewing them for a job. And the reason for that is that if you ask people what they earn, it tends to embed an existing gender difference in compensation. And so we've decided that not only obviously we have to obey the law in those two states, but we globalize that policy. So wherever we're hiring, and in fact this counts for both internal and external hires, we don't ask candidates what they earn in order that we can evaluate what the pay for the job is and find the best candidate, find the best diverse team and pay appropriately. And that's been a really strong policy, in my view, that we've globalized and has enabled us to get to a little bit of a better position. We've also instituted mentorship, which many companies do, both inside and outside our organization, and most recently sponsorship, where we've said we want to look for strong talent, strong diverse talent, and ask senior leaders to sponsor those people and really help them navigate the potential barriers that anyone might see on their road to a more senior position. So sponsorship is very important alongside mentoring. I think we accept they're a little bit different. So these are things we do as an investment team when we're looking inside our organization and trying to do a better job. And when we look outside, we're looking for the companies that we invest in to also, in a sense, pick up the baton and therefore move us closer towards these UN Sustainable Development Goals that I outlined right at the beginning. It's very heavily rooted in a fiduciary view. So these decisions that we've taken when it comes to our asset stewardship program and ESG in general have been, in a sense, battle tested against a fiduciary viewpoint. In other words, is this good for client outcomes in terms of long-term returns? Because we need to make sure that we differentiate from things that we think are very valuable and going to drive long-term returns from values that we might have. It's perfectly legitimate to have values, but when you're acting as a fiduciary, it's very important that you deliver the results that client wants. Because we have to keep in mind, with a global business like SSGA, we have clients who've got very different viewpoints around the world on a variety of issues. And so when we're advocating for ESG, for example, and taking action with from a stewardship perspective, that we're doing so with a fiduciary lens. And we could go to clients, even who have some hesitation about some of these issues, and say, we really believe in this, and we really believe it's going to deliver better long-term results. And I certainly believe that the actions we're pursuing and the goals that we're pursuing are very consistent with delivering better long-term returns for our clients. And that's why I think it makes it easier in a way to get the tone from the top to be very authentic when you've seen the evidence and you've got a degree of conviction in that research, and then you can argue the case within your organization, which is what I've been doing. So I've got the pleasure of being available for Q&A a little bit later, but I know we've got a panel as well that you'll be waiting for that I can participate in as well. So at this moment, I'll hand over maybe back to Martina and the panel.
Wonderful. Thank you very much, Rick, for these opening remarks and for setting the scene, really, and some of the key points that we want to elaborate and dive a bit deeper into later on, from the tone from the top into ultimately strategic implementation at the operational level. And we definitely will dive a bit later on into the fundamentals as well as how SSG is actually completing that mission. Absolutely right. I would like to open up the discussion now, first of all, to the panel. And I've provided you here with a slide on some of the key reflections on diversity, actually a research piece that I put together for the Global Female Leaders Forum last year. And I don't know if you have the time during this call or after the call to look a bit deeper into the research pieces that I've put together and highlighted. But I just wanted to give everyone a quick perspective on the key topics and themes that we are now discussing on the panel. So first of all, we obviously know that gender diversity, equality, and inclusion form a core part of the UN Sustainable Development Goals and are at the forefront of the sustainable finance, corporate, and public policy agenda as it stands now. And many academic and industry studies show that empowering and enabling women is not only up for an ethical debate, but also the smart thing, the right thing to do as it leads to increases in GDP, higher performance, return on investments, and more effective and innovative organizations. We also have seen from these studies that gender and economic inequality, as well as human rights abuses and human governance controversies, unfortunately remain key social issues and high on the ESG SDG agenda. And one of the examples here, the worldwide gap between women and men, remains particularly stubborn on issues such as work and obviously pay, and the best chances of equal treatment remain very mixed. So research by MSCI and SSGA, as we will hear today, and other investors have linked diversity to corporate financial performance. And their studies found that gender diverse boards can have a positive impact on a company's financial performance. However, less than 5% of, for instance, American companies as part of the S&P 500 are actually currently led by a woman CEO. And these are figures from 2018. In Europe, gender diversity and equality issues also remain high on the public policy agenda. That's quite interesting, and as EU member states have actually now implemented the EU Directive 2014-95, which requires companies with more than 500 employees to disclose information on ESG and diversity. And ultimately now with the Sustainable Finance Action Plan currently in motion, launched in 2018, we will see that investors are following suit. Gender diversity has also been identified as a strategic marketing opportunity, of course, for investment management. Millennial and female investors have become key drivers for sustainable investment as they're generally more concerned with social and environmental outcomes and with impacts beyond their financial returns. I'm just referring to a couple of very interesting studies here by Morgan Stanley's Institute, for instance. So with these key reflections, I'm delighted to open up the discussion to our panelists. And I know that we will have a couple of very, very interesting and insightful presentations now over the next 20 minutes, 25 minutes. But we will definitely have time later on for public Q&A. And before I'm leading into that Q&A, I would like to remind everybody you can actually pose your questions online by using the facilities here on screen. And we will make sure that we will read them out later on as much as we can and as much time as we have to the panelists during the discussion. So please do not hesitate to ask questions, get engaged, get active, and pose your questions on screen. Thank you very much, and I will revert back to you in a moment. Meggin, over to you, please.
Thanks, Martina. My name is Meggin Eastman, and I'm Head of Impact and Screening Research at MSCI ESG Research. MSCI ESG Research is one of the largest ESG research houses in the world, serving institutional investors around the globe. This topic of diversity, in particular gender diversity or gender equality, is one that we have focused on in our research for a number of years in-house and through acquisitions that we've made over the last several years. And it's been a personal focus for me as someone who authors a great deal of research over the last few years. Martina, shall I move the slides or shall you?
Happy to either way. I've just moved it forward for you. Happy to do it, whatever works best. Cheers.
Okay, thank you. So we talked to a lot of investors, institutional investors, and also folks who are serving the wealth market around the world. And one of the things that's emerged over the last couple of years is that after climate, diversity, and especially gender diversity, is probably the single next topic that our clients ask us about the most in the ESG arena, especially in the impact and thematic ESG space and in the wealth market, but also it's of interest to a lot of large asset owners and managers. As Rick made more than clear earlier, SSGA is certainly one of them. So we focused a lot of our research on women on boards. It's really at the core of a lot of our corporate gender diversity research, and also a lot of investors focus when they're thinking about gender in a corporate setting. But people sometimes ask me why that is. Why women on boards? They're already really kind of at the top of the success pyramid, so to speak. And there are a couple reasons for that. The simple answer, one of the first answers, is really data availability. Board membership is one of the few things that you can actually get data on comprehensively around the globe at publicly traded companies. But beyond that, as Martina mentioned earlier, there's growing evidence suggesting that actually these figures are a good proxy for things that are of keen interest to investors beyond gender equality. That is in itself of keen interest to many investors. But it also seems to be related to things like employee productivity and innovation capacity. For some investors, this is really a big picture issue, and equality is an ethical imperative. But there's also an element that I think Rick and Martina both kind of referred to earlier, which you might think of as kind of pro-system investing, where it's not so much about the individual firms, but about the broader context, especially for universal investors and those that have long-term investment horizons. Gender equality seems to be good for economies, and stronger economies tend to be good for portfolios over the long term. So there are a number of different reasons here, kind of falling into different buckets that are either investment first, equality first, or really both together. So a number of organizations, including MSCI, have done research that has found pretty compelling connections between board gender diversity and financial performance, but not always with much of an explanation for why that connection seems to exist. So we're aware through academic research and some of the research that we've done that diverse boards, diverse groups seem to make better decisions. They might be tapping talent more effectively, but that doesn't really seem like enough to explain the kinds of correlations that we've seen. So at MSCI ESG Research, quite a bit of our research over the last few years is focused on trying to dig into what's actually going on, and I think we're starting to scratch the surface there. So I am increasingly coming to believe that the presence of women on boards is a significant indicator of some of the much less tangible aspects of company culture, whether it's attitudes towards talent management and openness to things and ideas that are new or different perspectives and so on. things that are harder to measure. So I'll mention some quick highlights of research findings that we've had over the last couple of years that I think point in this direction. And I should mention that most of this research is publicly available on our website, or anyone who's interested can follow up with me after the webinar. So we found that companies with a critical mass of women on the board also tended to have more women among their senior leadership and more women in their workforces. We did a really interesting case study in Japan where a couple of years ago the government started mandating disclosure of a lot of different figures around corporate gender diversity. And we found that companies with even 1 or 2 women on the board were considerably more likely to have a higher percentage of women among their new recruits, new hires, and also all the way up through the workforce and into their senior leadership. So it seems to point, we don't know whether there's a causal relationship in one direction or the other, or whether it reflects something broader about how the company thinks about its talent. On that point, we've found that companies with gender diverse boards have tended to have stronger talent management practices than their industry peers on average. There seems to be a connection there. And that these companies with strong talent management practices had higher employee productivity growth compared to their peers, and that the ones that had the great talent management practices plus a persistent, extensive female presence on the board did even better than the ones that were just good at talent management, had good practices and policies. So there really does seem to be some evidence kind of piling up there suggesting that this is a reflection of broader attitudes and culture at the companies that are appointing these women to their boards. And then just finally, one kind of last piece of recent research that I did that I found really fascinating is that I looked at companies that have been publicly recognized as innovators by sources like MIT and Forbes and Fast Company that do these annual lists of 100 most innovative companies, that kind of thing, and found that over the last couple of years, the companies that have been recognized on these lists had considerably higher numbers of female directors and more consistently had a substantial female presence on the board than their industry peers, and not just by a little bit. So, again, we don't know whether there's a causal direction of this relationship or whether it's reflecting something else about corporate culture, but it does seem to suggest that this one figure, this one characteristic of companies is an interesting place for investors to take a look if they were wanting to get at some of these other harder to measure aspects of what's going on at companies. So with all that as background in mind, I'll just run you through a kind of a quick state of things. We publish a report every year that's basically a progress report on the state of women on boards around the world. Here's a snapshot. I hope you all can see the numbers okay. So we're looking at the MSCI All Country World Index here. That's about 2,700 large and mid-cap companies in developed and emerging markets. That's our standard benchmark against which we track progress year after year. And the quick takeaway is that progress is happening, but it's slow. Even with all of the evidence that I've just cited and that Martina and Rick have mentioned, that this is a good thing to do for business purposes as well as for purposes of equality. Often I have conversations with journalists and they'll say, with all this evidence out there, why don't more companies just do this already? And I think the answer is complicated, but that in a nutshell, there are still barriers. Whether it's companies that have appointed a single female director and feeling like they've done their bit, or nominating committees that are disproportionately looking to their old boys networks when they're looking for candidates, or unequal family responsibilities that make it more difficult for some women to take on these kinds of roles. There's probably all kinds of things going into it. So it really is an important area for investors who care about this to keep pushing at it, and from multiple directions. So a quick look at the numbers on the screen. So this is across the top, you've got companies, numbers that reflect companies in the MSCI ACWI index, and then on the bottom, the column chart there is what we refer to as directorship, so the number of seats filled by women among all of the directors at all of the companies. So we've still got more than a fifth of the companies in this set, which is the largest companies in the world, still have all male boards. That number has been coming down slowly, bit by bit, but not quickly. A lot of those boards are in Asia and in emerging markets, in Asia including Japan, and in emerging markets. A lot of the Western countries are getting down to where at least the large cap companies don't have too many boards like this. but we're still at less than a third that have reached the tipping point, we call it, of 3 or more. And that's a number that we refer to pretty often in the MSCI ESG research on this topic, because there's a strong basis in academic research that in groups roughly the size of a board of directors, 3 members of an underrepresented group is kind of the point where you get past tokenism and get into more, on average, more equal participation and influence. I'll just share one last piece of information here, which will maybe set us up for some of the further discussion we're having, which is that like 3, we often look at 30%. If you're on this webinar, you're probably familiar, at least have heard of the 30% Club, which has a goal of getting 30% of directorships at all companies held by women. And a few years ago at MSCI, we basically ran some scenarios looking at how long it would take to get there among this set of large global companies. And we projected that at business as usual, from the figures we were looking at 2009 through 2015, it would take until 2027. And this year we've pushed that out by another 2 years because contrary to our expectations, the progress has actually been slower over the last couple of years than it was prior to that. The number of seats coming up for a new appointee that are being filled by women has dropped. And I don't have a great explanation for that. The data doesn't tell us what's going on there, but it is a somewhat worrisome trend. I will stop there, Martina, and I think we can, that can be a good segue to move on to the rest of the discussion.
Wonderful. Meggin, that's been very helpful to set the scene and provide really a bit of a research foundation for the more practical discussions around inclusion tactics now to follow by Patsy. We obviously, again, please pose your questions. We come back to your questions. I've seen great questions coming in during the follow-on from the initial presentations and high-level points here by Meggin, Patsy, and afterwards Robert. And again, we have enough time for questions in a couple of minutes. Thank you, Patsy. Over to you.
Great. Thank you very much. Hi, everybody. I'm Patsy Dorr. And for the past 7 years, prior to the end of the year, I built the diversity and inclusion, sustainability, and corporate social responsibility functions for Thomson Reuters globally, and subsequently led them over the past 7 years. I left the organization at the end of the year, and I'm currently on my own, writing, speaking, consulting, and guest lecturing at universities as well on the topic of diversity and inclusion and social impact more broadly. So I love this topic, and I'm so excited to be here today. I think there's a lot of great information being shared, and I hope that you all are finding it very useful so far. So I'm going to provide a slightly different perspective on the topic. I'm going to talk a little bit more about it from the corporate view. And in terms of the slides, if you don't mind, Martina, moving them for me.
Absolutely. Done. We're talking about
Great.
the current landscape. Perfect.
Yes, perfect. So the current landscape, and I think most people on this call would be aware, there's a number of different factors from my perspective that are driving this increased focus on social impact in the broader sense of the word, and particularly diversity and inclusion as we are in today's conversation. Number one, we've got news, we've got rising voices through the Me Too movement, Black Lives Matter, et cetera. And this is not only in the United States, obviously, this is a global issue fully. Given our geopolitical environment, a lot that's happening both here in the U.S. and around the globe, rising voices being part of that movement, there's a need for companies to come forward and really play a much more active role in this space. And the other piece on the current landscape, which is not necessarily included specifically in my slide, but I'll talk to it, is that there are 3 primary constituents driving corporations to have to take social impact and diversity and inclusion more seriously. Number one, it's the talent within the organization, and it's the talent that we're trying to attract, right? We know, in fact, that millennials, 8 out of 10 millennials, make decisions on the companies they're going to work for based on how seriously those organizations take social impact and diversity and inclusion. We really have to pay attention to bringing in the best talent and therefore building out effective solutions to social impact and diversity and inclusion. The second bucket of constituents is really our clients. I mean, when I was at Thomson Reuters, and prior to that, I spent 20 years in investment banking all over the world. We see that our clients are wanting to work with organizations, again, that take diversity and inclusion seriously for all the aforementioned factors in terms of the impact on employee engagement, productivity, innovation, and ultimately the bottom line. And I saw at Thomson Reuters in the past 3 years a significant increase, 84% actually over the course of the past year, in terms of the number of questions asked on RFPs for business. So proposals for business, companies would be saying, okay, tell us your diversity stats. How many women do you have on your board? How many women do you have in leadership, et cetera? And it was a fascinating exercise to see our clients really taking that topic much more seriously. And then finally, the third bucket of constituents are really the investor community. And of course, that's already come up with our prior speakers as well. Impact investing is a massive undertaking now. We're at about $24 billion US dollars globally, rising at about 17% a year. So investors, as was mentioned earlier, are really looking to invest in companies that take diversity and inclusion seriously. And if you'll see on the second slide, thank you again, Martina, why does this matter? Some of these facts we've already mentioned, but 81% of potential employees consider these factors. As I mentioned, 8 out of 10. CSR is responsible for a 40%, and there's a lot of research out there. These are some of the stats that I've pulled from a variety of different reports. But absolutely, the CSR takes up about 40% of a company's reputation. And so people are getting more serious about evaluating how organizations are addressing these topics. And finally, we do know, and it was mentioned just a moment ago by Meggin and also by Rick as well, is that there is research telling us that there is a positive correlation to the bottom line. Whether it's a causation or not is still a question, but we do know that there is absolutely a positive correlation to financial returns. So if we move on to the next slide, what I'd like to talk about over the next just couple of minutes, knowing that we want to get into discussion rather quickly, is how the heck do you do this right? So how did we do it at Thomson Reuters? And I do a lot of writing and speaking on this topic and obviously feel very passionate about it, as do all of my other fine colleagues on the call here today. But there are a couple things that companies really need to consider in order to build out an effective social impact, and again, particularly diversity and inclusion strategies. Number one, you've got to have support from the top. The CEO needs to believe this is the right thing to do and believe that there is a solid business case to make it a reality. And on a personal note, the reason I joined Thomson Reuters, I actually moved back from Hong Kong. I was running talent for Credit Suisse in Asia and got a call to come back to the United States to build the diversity and inclusion function for Thomson Reuters because the CEO, who was assuming his position at the time, wanted to make diversity and inclusion part of the business case, part of our business strategy, part of our brand efforts, and really truly believed in it. And you've got to have that support, and certainly across the leadership of the organization. When I was at Thomson Reuters, we're looking at 50,000 people in 100 countries, so you really need to have a significant portion of your leadership team focused on this topic, not only role modeling it, but actually delivering and looking at the statistics and playing an active role on a regular basis. The second piece is integration. I've seen a lot of organizations fail, particularly around diversity and inclusion, when they put the efforts separate, right? Diversity sits in this separate office. They're not integrated in terms of human capital. They're not integrated in terms of the business strategy and the brand strategy. So really making sure that diversity and inclusion is part of the overall message of what the organization stands for. The third point is around education. And I think about this in the broadest sense of the word. In order to have an effective diversity and inclusion strategy, you really have to ensure that the strategy looks across the entire employee life cycle. And that's where education plays a role. And what I mean by the employee life cycle is everything from recruitment to development to advancement to engagement and attrition. And every single piece of that life cycle needs to have a program, a policy, and more importantly, initiatives and support around making sure that we're taking all aspects of that seriously. So for example, and by the way, Martina, I'm slightly kind of moving around on the slides here without following them to a T, moving into the Thomson Reuters case study piece. We, for example, if you think about recruitment, and this was mentioned earlier, a lot of organizations are moving towards removing that bias from resumes and CVs and the like in terms of not showing names, for example, so that people are not aware of the gender or even the ethnicity of individuals applying for roles. We put in place similar processes in addition to mandating diverse slates for every role. We started off mandating it for senior roles, and then we did it across the entire organization. So that's an example around recruitment. Development, absolutely critical. Make sure that you have in place leadership development programs that focus on building diverse leaders. And one of the things that we felt strongly about, and I feel strongly about, is that being a diverse and inclusive leader, again, should not be a separate exercise. Just being a good leader means you know how to build diverse teams and to lead them and to educate people around that, not only the leaders themselves, but everybody in the organization to appreciate that and hold individuals accountable for building and leading diverse teams. The final point at a macro level in terms of getting this stuff right is transparency. And I'm starting to see this as I do more consulting work across a number of different organizations, that there's a real cry and a need for transparency of data. And a lot of our companies on the panel today have talked about that already. The issue is that it used to be that people were not as willing to share their statistics around diversity. And now we have to. Now it has to be in your annual report because, again, getting back to where we started, clients, investors, and the like are asking these questions. So we're starting to see a lot more focus on transparency and having some very clear goals in terms of what that impact actually means for the organization on a broader scale. So those are some of the key components. The other piece I'd like to highlight is that it's important as well to make sure that you have the right balance between diversity and inclusion. So diversity, you can bring in a whole bunch of diverse people into an organization, but if the culture doesn't support it, it's never going to work. And that's really the inclusion piece, making sure that you're building a culture, that we're building a culture that allows diverse talent and frankly all employees to thrive. And then finally, before we open up for questions and continue the discussion further, I pointed out here on the slide the case study being Thomson Reuters. So what we did, and I'll just share this with you briefly in addition to the examples I mentioned earlier, is that in addition to building out diversity and inclusion, about 2 years into that journey, I was asked to do the same with corporate responsibility or community investments and sustainability and to integrate them. And we did a whole host of different programs and initiatives, which are listed here on the slide as well, and I won't go into a lot of detail at this point. But at the end of the day, the idea was to say, with the Sustainable Development Goals as a backdrop, how do you actually align sustainability, community investment, and diversity and inclusion, where it's really about people giving back and then building, again, that culture that supports it. And then finally, one of the things that we did that we were particularly proud of is in the past couple years, given the rise and the focus on transparency of data and ESG data, we created something called the ESG Institute. An exciting name, I know, but at the end of the day, the idea was to educate our employees on what ESG data is, why they should care about it, and as well to do thought leadership and reporting around ESG data. You know, we had a database of ESG data that tracked it on 7,000 companies around the world. So the opportunity really was to leverage that data, but also to highlight the issues and to help people understand the importance of it. And finally, one more example, not here on the deck, but we also created, and it's still out there in the marketplace if any of you are interested in taking a look at it, a diversity and inclusion index based on our ESG database. And so we work with our ESG team to identify those 24 metrics that define an effective, diverse, and inclusive company. And every year, and it's been 3 years in the making, we release the index to the marketplace, listing the top 25 companies around the globe. And that still exists within the Thomson Reuters portfolio. So if anybody's interested, I'm happy to share that. But that's one very specific example of how we took that ESG data through the ESG Institute and linked it back to our business goals around diversity and ultimately released it to the market so those companies could understand what they're doing well and what they're not doing so well, including ourselves, by the way, and investors could utilize that index to build out their portfolios as well. So I will stop there, but that's a little bit about the backdrop, case study, and some of the key principles in terms of building out effective social impact functions. So back to you, Martina.
Wonderful. Thanks a lot, Patsy. Interesting storyline here from the tone from the top into ultimately research implications and now tactical initiatives. I can definitely see here now how ultimately diversity and inclusion is becoming an integrated strategy. I'm handing over now quickly to Robert. I mentioned earlier that he and obviously Rick are working very closely together at SSGA to implement at an operational and transactional level all the tone from the top views and concepts around diversity, empowerment, and inclusion. And Robert, I've seen some of the great research here as well, and I'm looking very much forward to the presentation. And again, please, everybody else on this call, ask your questions. We will definitely come back to them. I will cluster them, and we will post them back to the speakers a bit later on. Thank you. Robert, back over to you.
Thanks, Martina. So, hi, I'm Rob Walker. I head up Asset Stewardship for EMEA at SDG Global Advisors. It's a great pleasure to be here this afternoon to talk about stewardship and in particular our Fearless Gold campaign, which we launched in 2017. So I just want to kind of start with the kind of first slide. And I think all of the kind of panel speakers have kind of focused on this point, why does diversity matter? Rick, in his opening comments, talked about the fact that we are about value and not values. Our premise as a global investor is about creating sustainable value for our clients, and so that is at the foundation of our approach to Fearless Girl. The notion that companies that have a woman on their board tend to outperform companies that don't. And that comes from a McKinsey study. And so this slide is really showing the kind of case for that. In terms of the economic benefits, I'm referring to a report that we did, which I'll refer to in a couple of minutes on the GCC, the Gulf Council countries, where we were looking at the need for why these countries are looking at improving the penetration of women through their economy. And the rationale for that is the economic benefits of diversity. So the fact that for the GCC, if they were to bring their level of diversity up to equal with men in their economies, they would create an additional 830 billion of new GDP, and that again is a McKinsey study that we've used. And so for us, diversity is all about about creating economic value, but it's also about protecting and enhancing shareholder value as well. And so we found a number of studies that have demonstrated that companies with greater levels of gender diversity, of course, have stronger financial performance, but they also have fewer governance-related issues such as bribery and corruption, shareholder battles and fraud. And so just coming on to our Fearless Girl campaign, this is a campaign that we've been running since 2017, and we're in our second year of that. And this campaign is all about engaging and where necessary, taking voting action at companies that we've identified as not having a woman on their board. And so for us, this is really about demonstrating the impact of stewardship. We can use our voice, and where necessary, we are willing to use our vote as well to affect change. And so since the start of the campaign in 2017, we've identified 1,227 companies across a number of markets. So we started with the US, UK, and Australia in 2017, and we expanded into Japan and Canada in 2018. And so effectively, since we started the campaign, 301 companies have added a woman to their boards, 28 have committed to do so. And in terms of voting action, it's been an interesting journey. So in 2017, we voted against the head of the nomination committee, where there wasn't a woman on the board, and the company had failed to address that. In 2018, that number's gone up to 581, but of course, that's also due to the fact that we've expanded the number of markets that we've been looking at. But just to put that into context, what we're really saying is that 35% of companies that we've identified year to date as not having a woman on their board have actually added a woman to their board. That's up from 14% in 2017. So we're making progress, but there's still a lot of work to be done. And so I just want to come on to our work in the Middle East. So, we're constantly looking to expand what we're doing on diversity. And so last year in Q4, we wanted to look, or we were invited actually by the 30% Club out in Dubai to do some work for them, looking at the level of board diversity in the GCC. And one of the reasons why we were interested to do this was because with the inclusion of Saudi Arabia and other GCC equity markets into the FTSE and MSCI indices over time, we believe there's going to be more pressure on companies to improve their diversity across all levels of their organizations. So we felt that this was the right time to look at this issue. And of course, as part of our study, we found that the relatively low level of women in the workforce definitely offers more upside potential in other markets. And again, that comes back to my previous slide where I was making a fact that this 830 billion of new GDP that's possible if GCC countries increase the level of women to that of men in their societies. And what's interesting is that we noticed as part of our research that all of the GCC countries, as part of their economic plans, so the economic plans for the next 10 years, they all have within those plans, as a core part of that, their desire to improve the level of women in their society. So clearly they view, improving gender diversity as a core part of their economic development. And so, what is State Street's approach to diversity in the GCC? Well, essentially, we are not going to take voting action against companies with no female directors on the board at this time. And the reason for that is because we believe that, it wouldn't have an effect, that the companies, need some time to, put in place policies to kind of get on top of this issue. And so taking voting action at this time wouldn't really progress this issue. Instead, what we're going to do is we're going to work with companies and wider stakeholders to increase the debate and to help companies take effective action on this issue. So an example of that would be that I was in the Middle East in December last year, talking to companies and regulators about diversity and how we can help. So an example of that is I had a meeting with the financial regulator in Abu Dhabi, and we were discussing how they could encourage companies to improve the level of women on boards. And we think that basically investors, companies, and governments need to work together to speed up the pace of gender diversity in the GCC. And so just finally, I just want to leave you with an overview of the state of play in terms of gender diversity in the GCC at board and executive level. We looked at 170 blue chip companies across the region. We found that only 23 or 14% of companies have at least one female director on the board, so there's clearly a lot of work to be done. And in terms of women at the executive level, we found that the average percentage of women at senior management level in the GCC is approximately 5%. So again, there's a lot of work to be done there as well. So just to conclude, because I'm conscious of time, I want to leave some time for questions. We believe that the GCC will begin to look at this issue. Companies are beginning to take it on board, and we're going to work with companies and wider stakeholders to improve diversity in that market. And of course, we're going to continue through our Fearless Girl campaign to engage and encourage boards to improve the proportion of women on their board. So without further ado, I'll hand back over and maybe we can open up for questions.
Wonderful. Thank you, Robert, very much for this perspective. And I'm sure we will dive a bit deeper into the discussion, developed versus emerging markets or West versus East, given that there is very often a question around, is this really a geographical challenge? But maybe before we dive into the specifics here of the different type of geographies, types and sizes of organizations, I would like quickly to recap and bring Meggin and Patsy back into the debate and just really thinking this through of what you said earlier. Why is gender equality really becoming a key concern for employers and for investors? A quick recap, why is this so topical now? Has it become very topical, or is this a continuous momentum that's been building? Where do we stand?
I can go first. This is Meggin. Just very quickly, I think Patsy and I both touched on some things that it's been a topic of interest for investors for some time, but has really risen to the top of the list in the last year or two, given developments politically in the world, politically and in the business world. Patsy?
Yeah, thanks, Megan. I would agree. I think we touched on some of it as well. And I would just add that I think particularly on the investor side of the house, what we've been hearing over the past couple of years is that the latest figure I heard is that 75% of assets under management, about 60 to 7 trillion US dollars, within the next 3 to 5 years, will be in the hands of women and millennials. And I tell you that because, with all due respect to all of the fine men on the call here today, that women and millennials on average care more about diversity and inclusion in terms of investing practices. And so with that asset allocation underway, or in terms of where those assets will sit going forward, I think that's also played a big role in terms of us, all of us, corporations, investors, as well as financial services organizations, having to take this topic more seriously, knowing that they're going to be investing in companies that are focusing on diversity and inclusion. So hopefully that is another data point to be considered in the debate.
Very much so. And maybe, Robert, coming back to what you just stated, and also then bringing Meggin back into the research that she also showed from MSCI here. I think we talked about the different geographics, maybe even demographics. We talked about the different types of organizations, maybe also size makes a point here, or is another key factor. Has your research actually found, MSCI and SSGA, that the main discrepancies when it comes to female distribution and participation in the workforce, for instance, that this is just a board issue, or is there also an issue for the wider organization at large? And you can probably see and hear already from my question that I'm pointing towards that direction, but keen to hear more.
Yes, I would say that there definitely is. It's harder to do research on that because of the data situation. But we've also found, as we've looked at women on boards, that there seems to be a pretty close tie to what's going on at the board level and what's going on at the rest of the company and amongst the people getting hired.
Mm-hmm. And Robert, maybe from your perspective as well, what you have seen in GCC countries, as you mentioned, or ultimately in globalized organization or global organizations, do you see that same sort of trigger? Do you see actually issues remaining, key concerns remaining with this female participation and distribution figures, and does it actually change over time? I've read research, and I've actually highlighted research in my own study of when, how ultimately the situation changes from females entering the workforce at the same level as men, and then ultimately slightly triggering down in numbers when it comes to the time when obviously we start families, and we might also take up more of a shared work-life balance view. But is that actually represented in your research? Have you found similar traits of these sort of indicators in global organizations or some of the specific countries you were looking at?
Yeah, I definitely agree with that. I think it's when you look at women in most companies, it's about 50-50 as they come into the workforce, and it's a bit of a kind of hourglass effect that as you kind of get to the middle, that it kind of drops off. What I would say is that we hear a lot of different anecdotes from companies for why this is. So we've had conversations with companies where they've told us, for example, hey, the kind of introduction of quotas in different countries has hurt us because, we spent years building up a pipeline of women at the executive level, and they've now left to become professional non-executive directors. And so we're having to kind of rebuild the pipeline. Of course, we've also heard from companies, we just can't find anyone. So I think that what the Fearless Girl campaign has definitely highlighted is that, once you start to kind of draw visibility on this, and you link it to the kind of, value argument, it's very difficult, I think, for companies to push back against this the need for diversity.
And is there actually, in bringing in also Rick now into the discussion, he mentioned earlier ultimately establishing the tone from the top, and then integrating this view with ultimately best-in-class diversity and equality initiatives and outcomes. But is there actually an opportunity cost, potentially a cost to capital that organizations have to overcome? What's been the lessons to be learned from an SSGA perspective?
I think there's a good payback from taking the kind of actions that I've outlined, including, greater flexibility. And when I think about our strong female leaders, they've often been through a very long career during which at times they have had flexible working arrangements or part-time. They've managed that, their team have managed that around them. So there may be a cost, but I think the payoff is very clear. I think the other point to note is that this might seem to men a headwind. Well, I mean, guess what? Men have had a tailwind for a pretty long time. I don't think it's designed to be a headwind against anybody. I think this is designed to promote equality in order that we get better organizations. But if you're going to do that, you're going to have to take some actions. And those actions like sponsorship, where you're focusing on diversity, not just gender, but other elements of diversity, they're really important. I think that trade-off is one that's a good one. And I would not, it's going to sound like I want my cake and eating it, which is a terrible expression, but, I do think that this payoff is very strong. But it does require you to take some actions. And those are new things for people, and I think they have to get used to it.
Yeah.
And maybe
if you don't mind, Martina.
Sorry, please, Patsy, come in. Exactly. I wanted to bring you into the follow-on from here, but please, yes, comment on this, please.
Okay, sure. I was going to say, just perfect. Just to build off of some of those points, I also think it's really important, and this may sound a little bit debate-oriented, but that's where we're here today. I do think that when organizations over-focus on the fact that women are not rising into leadership positions because they are having children and requiring flexible hours, we do ourselves a disservice. I think it's important to put in place flexible working practices for all, for everyone, frankly. And I echoing some of Rick's comments about the importance of the headwind, but also the second thing I would say is it's really critical to build that culture where women can thrive. And we've touched on a lot of that. We can obviously get into more detail, but it's really that culture and breaking down the biases that exist around how women might take their career more or less seriously when they have children or other aspects of their life, when in fact, again, we need to take away that bias and think about the broader population at large at the same time and put those programs and policies in place. That makes sense.
Yeah.
And that probably might also overcome some of the conundrums, right, that we have seen between what we established as a tone from the top and the senior management perspective, the strategy, versus ultimately how initiatives are then implemented at a middle management to even a junior management level. So and this is, for me, still the ongoing conundrum here, and we might dive into that in a moment. But I also want quickly to ask, again, Robert, from your perspective, can actually tighter regulation and can mandatory actions and taxonomies, now what we're seeing here in Europe with the EU Sustainable Finance Action Plan, can they make a real difference? Or are these initiatives or these regulatory mandates becoming really, again, an opportunity cost? Do you see also transparency on the issue? For instance, what I've highlighted earlier, the EU Directive 2014-95, disclosure of non-financial information diversity. Do you see that these initiatives really make a difference?
I think they can make a difference. I think that, I don't necessarily agree there's an opportunity cost because, some companies are doing it already. So I don't necessarily think it's onerous. And I think that the more information you have, the better able investors are to kind of look at what companies are doing and engage with them. So I would kind of parallel that with climate change and say, well, if you get more information on what companies are doing, you're able to kind of link that to their strategy and work out where the risk might be. And so, we're already seeing that, more information on, in the UK in terms of kind of pay gap data is helping in that respect. And as part of our engagement with companies on pay, particularly in the US, for example, we've begun to have conversations with companies about, how they are recognizing the potential differences in how minorities are paid. So, no, I certainly think that more disclosure can help because it also forces companies to think about these policies. So if you're requiring companies to disclose more on what they're doing on diversity and they have to create a policy around it and they have to report on metrics, then they're going to have that internal conversation and they're going to have to build processes around that in order to report on it.
Yeah. Yeah, fully agree. And maybe that also, this increasing transparency, disclosure, maybe also regulatory pressure, I fully agree. I don't see that as per se an opportunity cost. I see it as opening new opportunities and ways actually to integrate finally these strategic and tactical perspectives within organizations. But I see there was an interesting question here as well coming from the panel. Maybe to Meggin, but also, Robert, to you in the broader context of the research that you're both undertaking. Is the decline of women, I take it as women on boards, calculated on the MSCI World Index? And is the fact that the average share of new seats has declined influenced by the effects of Me Too campaigns or on disclosure on gender pay gaps, for instance, which brings us back to the wider transparency discussion?
So
Meggin,
it is calculated on the world, although the ACWI is kind of our benchmark there, and we've actually seen faster increases lately in the emerging markets than we have in the developed markets, albeit from a lower base. The data doesn't tell us why the rate of new seats being filled by women is slowing down. So overall, the numbers are still going up, but they're going up more slowly, if that makes sense. And, it could be some backlash to the political environment. One of my personal favorite hypotheses is that as the number of companies with all male boards has declined, that the pressure seems to be off a lot of them, that if they've got at least one woman, then they sort of feel like they've done their bit, it's less pressing. But that's a hypothesis. I don't actually know it. Rob, I'd be interested if you have any insights from your own side.
No, I don't have any direct, insights. I'd agree that, what we've seen is that in terms of our campaign anyway, we've seen that the kind of obviously companies that don't have women on the board have clearly been able to increase that number, and so that's a key part of what we're trying to do. I would say that in terms of board quotas, well, if we look at Europe as an example, most countries in Europe now have a quota around the number of women that need to be on the board. The issue around that, I would suggest, is that those women need to come from somewhere, and so that raises the question of, well, how where are these women going to come from? They typically come from the executive management level, and so that's why now when we speak to companies, we're having a lot more conversations with them around how they are increasing the number of women at senior management levels. So a lot of companies that we speak to now are talking about the fact that they're setting targets and they're linking those targets to the pay of their senior management, which I also think is very interesting. And they're also using mentorship programs as another way to drive that. So I think that's also a good example of how you can kind of improve diversity at all levels.
Thanks a lot. By the way, I've been just informed we have 1 minute left, so maybe, Rick, quickly over to you. Before we conclude, 10 years from now, what will change or need to change to guarantee diversity, equality, rights, and initiatives, and to keep them on the agenda, top down?
Nothing's guaranteed, but I think the momentum that we've got now behind the issue is really substantial, and I think the evidence will be much harder to dispute. And so I feel optimistic that in 10 years we'll be at a much better point. We won't be at the final stage, but we will be much better than where we are now.
Fantastic. Well, thank you very much, everybody. Apologies we had to cut it short, but thank you, and we speak